Good morning and welcome to this Wednesday, October 14th, 2020 edition of Trading Places Live here at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. We got pretty good action, I think, still in the market. I think the stock market here in the U.S. looks really strong. I see really the formation of a lot of cups on our major indices. I guess the question remains whether or not we'll see handles, whether we'll just break right through. We do have a major historical bearish period lurking from October 21st to October 27th. Doesn't go down every year, so I wouldn't be worried that it's a guarantee, anything like that, but we need to be aware of it. And I think there are reasons for it. Usually you have a pre-earnings run up in every quarter. We already know the 19th to the 25th historically is bearish. So there's reason to always be concerned if you've had a big advance heading toward options expiration and the week following options expiration. We had a really good session last night over at Earnings Beats regarding October max pain. And right now, options, if you looked at just options and nothing else in the market, you'd probably expect that maybe we'd see a little bit of a pullback. But we'll get into all that here in just a couple minutes. First, I want to just take you over to Earnings Beats, especially if you're new to Earnings Beats. Just show you our website here. Go to our homepage, earningsbeats.com. Love to have you try out our free Earnings Beats Digest newsletter. Comes out every Monday, Wednesday, and Friday. Focuses on relative strength, earnings, those sorts of things. Usually some educational slant to it. And it's free. No credit card required, unsubscribe at any time. All you have to do is simply type in your name, email address, hit that subscribe button. We'll start you on that subscription. If you'd like to join us and give us a 30-day trial, we have a refundable $7 30-day trial. So you pay us the $7 up front, we refund you the $7. You enjoy our service for 30 days, no cost. And then you can decide whether or not our service is for you. We do have a very, I would just say a growing membership. I think we're doing something right. We've got some great services. One thing we're going to be doing later today, and this is open to the public, but earnings is a big part of what we do at Earnings Beats. And so every quarter we go through and take a look at all of the upcoming earnings reports, or many of the upcoming earnings reports, and I give you an idea of which ones I really like and which ones I really don't, based on the way these stocks are trading, based on their industry groups and so forth. That event is going to be our Q3 earnings event, which takes place next Tuesday at 4:30 p.m. But we give you a little taste today in the sneak preview of Q3 earnings. So here we'll be talking about some of the companies that have just reported. We'll be looking ahead over the next couple of days, maybe into early next week. Companies that will be reporting, just to give you a taste of what we do. And then, like I said, next Tuesday is when we're looking at literally thousands of earnings reports, and we're going to narrow down the best ones and the worst ones that we see coming up and highlight those during this Q3 earnings event. So if you want to just give a look at how we approach earnings season and how we approach earnings in general, my background, I was practicing CPA for 20 years. I was a principal in one of the largest CPA firms in the Washington, D.C. metropolitan area. Earnings and fundamentals are still near and dear to my heart, but I've learned that you don't need to study the earnings reports to figure out what's going on in the stock market. Technical analysis will give you a lot of really good information. That old Wall Street adage or saying that technicals precede fundamentals, it is absolutely true. Coming from the CPA side and then also from the technical analyst side, I feel very comfortable saying technical analysis and technicals precede fundamental analysis and fundamentals. All right, let's go ahead and move on. Take a look at what happened on Tuesday. We did have the major indices pull back a bit, but really it wasn't bad. I mean, when you think about how far the market's come here over the past few weeks, we've gotten back almost all those losses that we saw in September, talked about the sentiment issues that we had going into September. We needed to pull back. We needed a period of consolidation before we got into the fourth quarter, and that's exactly what we got. Now we're getting what we normally get as well, which is a pre-earnings run to the upside. Dow Jones Industrial Average, S&P, NASDAQ, mid cap, small cap, all five yesterday were down. NASDAQ barely. So showing leadership once again, NASDAQ was down just 0.1%. The other indices, though, except for the small caps, were all down less than 1%. And considering how far we've run, the S&P 500 was down to 3210, I think, at the low. And so we had just gone up to 3530, above 3530. So pulling back 22 points really is not that big a deal. In fact, what I would be watching now is this rising 20-day moving average. We've got all these 20 days that have turned back up above the 50-day. So looked like maybe we were getting these death crosses, and we were on some of the indices. You see it clearly on mid caps and small caps. But look, we've come right back up, and now we're getting golden cross back to the upside. This is necessary for a bull market. You can't have a bull market with your 20-day moving average below your 50-day. You can't be in an uptrend, at least, let's say that. You can be below in a bull market. You're simply consolidating, or you're going through a period of selling and weakness. But I think that period is over. I said probably a week, maybe 2 weeks ago, that I was pretty sure that mid-September low was the low. Once we started climbing back above moving averages, even on the hourly chart, that was giving me signs that we had printed a bottom. And so I think our bottom's in for the short term, probably for the intermediate term. If we don't hit some kind of major derailment from October 21st to the 27th, from a historical perspective, just remember 61 of the last 70 years, that's pretty strong, 61 out of the last 70 years, the S&P 500 has advanced from the close on October 27th to the close on January 18th. I'm not saying it goes up every day. I'm saying that the value of the S&P 500 on January 18th versus the value on October 27th, the closing prices, we've seen a rally. We've seen it move higher, 61 out of 70 years. That's a very, very high percentage. And it is the most bullish time of the year historically, once we get past October 27th. So keep that in mind. I think the market's looking for strong earnings. I have seen very few warnings. And usually, if you're going to get warnings, you get them in second half of September into the first week of October. We're beyond that period. I don't see much in the way of warnings. You know, even looking at banks and so forth that are coming out with earnings now, for the most part, most companies are beating estimates. Doesn't mean their stock price is going up, because the market still is looking at their earnings growth going forward. It's discounting it back. It's sticking with growth stocks, and I'll show you that in just a little bit. But anyway, I think the market's looking pretty good. As we look at the various sectors, industry groups from yesterday, communication services was actually the only sector to finish in positive territory. Discretionary, though, was essentially flat, down 0.02%. Financials, the weakest. 10-year Treasury yield took a big hit yesterday. That normally is not a good thing for financials, and it wasn't yesterday. Look at the AD line on these different groups. So look at communication services. Look at the discretionary group. AD line looks great. Look at financials. You see the difference? This is kind of important, because accumulation distribution only tells us what happens during the trading day. So forget about all the media hype and the headlines up and down and so forth. Accumulation distribution pays no attention whatsoever to the gap. So when we're in a volatile period, an emotional period like we've been in the last 6 months, I think the AD line is pretty significant, because it's telling us after the opening bell what's really happening while the money is moving throughout the trading day. Financials are not good right now. I mean, we can look at it and say, well, yeah, but what if we get this triple top? Well, I want to see this go up. I want to see relative strength turn higher. Financials have been horrible relative to the S&P 500. Yeah, okay, we're up here. We're looking at maybe breaking out. Even if we do, look at the S&P 500 during this whole period. Look at the high back in June on the S&P, and look at where we are now. The high on the XLF was above where we are now. You don't even need to look at a relative strength chart. You can just look at those two charts and see financials are not keeping up. once again, and I feel like a broken record, Groundhog Day with Bill Murray, but renewable energy, top performing industry group yesterday, kind of crazy. Recreational services, I'm going to talk a little bit more about this in a few minutes. This is where you get your cruise lines and so forth. They were just horrible yesterday, absolutely horrible. And you can see on a relative basis where we sit versus that June high. We're down 30% from the June high in recreational services. Got to stay away from the groups that aren't working. Stick with the leaders. I can't emphasize this enough. Let me go back over here. If you haven't seen this before, check out our portfolios. We only go with leading stocks, 10 equal weighted leading stocks in each portfolio. So essentially 40 different stocks. We do have Apple in both our model portfolio and income portfolio. So 39 different stocks that we have in our portfolios. And look at what they're doing this quarter. Every one of our portfolios is just crushing the S&P 500. Model portfolio, 15%. Aggressive portfolio, 8%. Strong AD portfolio, almost 18 percentage points better than the S&P 500 this quarter. Even our not diversified, but our more conservative income portfolio, dividend payers, beating the S&P this quarter by almost 3.75 percentage points. It's hard to do it. It's hard to beat the S&P 500, period. It's hard to do it with 10 stocks, but to do it in 4 different portfolios with 4 different groups and sets of stocks by this margin is hard to explain, except I can say that it pays to stick with leaders. But check us out if you haven't already. I think you'll really like our approach, and hopefully it changes the way you approach the stock market. We've gotten a lot of testimonials in that regard where people are like, hey, I finally found something that makes sense to me, that works. Check us out, please. All right, let's move on. And I want to talk a little bit about this recreational services group. So this includes a lot of different areas, and I'm going to talk a little bit more about that. I'm going to break down the group in a minute, but right now what I want to do is just look at the chart. We had the huge steep drop. January, 150. March, 30. 80% gone in 2 months, which was, more than any other group. Airlines gave it a run for its money, but I mean, that is from January, that was a massive, massive decline. This, I think a lot of this for 2 or 3 months was more a dead cat bounce. We had this move here to the upside, but even while we were going up here, the AD line was going down. And the reason being, we were seeing a lot of closes that were well off of the high of the day. So we just weren't able, at best, these 4 or 5 days, maybe we went sideways. But these days, look at these big red candles, a lot of filled candles. That is telling us that the selling was taking place throughout the day. So in addition to some gap downs, we also were seeing tremendous distribution throughout the day. That's the only way that institutions can get out. They don't get out on the market open with a market order. They've got to sell a lot of shares, and it takes place during the day. And when they're selling a lot of shares, even if individual traders are trying to go out there and buy their 100 shares or 200 shares, it's not even going to make a dent because institutions are selling. That's where you get these big red candles. Now, on the way back up here, like I said, not much. Went sideways. As soon as we start selling again, right back to a new low. Then we rally back up, we go flat. Here, we got a little bit of strength. Saw the AD line pick up. We moved down and put in a new low on the AD. It wasn't really until May that I would say that there was any accumulation whatsoever taking place in this group. We had a nice run from mid-May to early June. And since then, AD line's been relatively flat, ups and downs, but relatively flat. Same goes primarily with the overall action. I'm not going to be interested until this group begins to show relative strength. So for me, I'm going to pull up a price chart here. And let's take a look at this. And action. So this is what I'm talking about. So the RQ recreational services on a relative basis got hit hard. did gain a little bit in relative strength through June, but my gosh, it should. Look at the steep drop. I mean, it was a dead cat bounce. Since June, though, look at the relative strength. I mean, we're down from where we were in June, obviously, because prices are down from where we were in June. We're not seeing relative strength. So if you're trying to beat the S&P 500 and you're trying to do it with cruise lines or any of the stocks within recreational services, you're going to make, it's going to be an uphill battle. You've got to be looking at leading stocks in leading industry groups. And I think the first reaction to most people is, oh my gosh, these stocks have gone up too much. Peloton doubled. It went from 20 to 50. It went up too much. Well, no, it didn't. It's now 130. And who's to say it's not going to be another, 150, another couple of weeks? Who's to say it's not going to be 200 at the end of the quarter? Wall Street's getting into those companies for a reason. And we can sit back and shake our head and say, well, I can't chase. I'm not going to get those. Let me get these value stocks. I'm going to get me some JP Morgan, and I'm going to get me some Norwegian cruise lines. And that's not working out very well. Maybe it will someday, but that is value investing. That is going against the grain, against the crowd. That is not what we do. If that's what you do and you're successful at it, congrats, and stick with it. I wouldn't change a thing. You're not going to enjoy our service. But if you're struggling with this market, I think you'll like our service. I think you'll like what we do. All right. Before I break down this group, recreational services, what I wanted to do is just show you, this is a chart of the IWF versus the IWD. I look at this a lot, and especially throughout this pandemic, last 6-7 months, I've been looking at it a lot because you can see what's happened since March, since this pandemic hit. This has been a growth environment. You want to be in growth stocks, not value. When we had the pullback in September, growth got hit, profit taking. So we got hit the middle part of September, but this is rallying back. And now we're at about a, 5 to 6 week high. And we're not far from breaking out yet again in growth versus value. So this is a, really important chart to keep an eye on. All right, let's move on to break it down. I want to show you, we talked about the fact that recreational services are so weak. So I'm going to go into the scooter reports. And we'll just look at large caps. But I'm going to type in here, recreational services. And you've got Royal Caribbean Cruises, Live Nation Entertainment, and then 2 more cruise lines. That's what you got in the large cap space. Now we looked at, or I talked about the cruise lines. I'm going to pull up Live Nation Entertainment, LYV, because this one, look at it trying here back in September to get through that high at $60. Couldn't do it, pulled back. I mean, this looks a little bit better than cruise lines on a couple of different fronts. Number one, look at accumulation distribution when it hit its high. It was at a 52-week high. So if I'm looking at recreational services, I see this stock as a much better alternative to cruise lines right now. And a breakout above 60 would be very tradable. I've said before, and I'll say again, I'm not sure going forward the next 3 months what's going to lead this market. I'm very comfortable, no guarantees, but I'm very comfortable stock market's going higher. The thing that I never know for sure until I start seeing it is what leads. Is it going to be growth? Is it going to be value? Is it going to be small caps? Is it going to be large caps? I can tell you right now what the market is saying, but I can't tell you for sure what the market's going to say over the next 3 months. I just watch it evolve. But this is a group, or this is a stock right here, that certainly could begin to pick up some strength. If all of a sudden the virus talk, begins to die down, and I know cases are picking up again here in the US, but we don't know what the next 3 months, 6 months, 9 months holds. And when the talk begins to die down and we don't seem to have the problem with the virus anymore, and we are going to get to that point, I think the big question is, do stocks like Live Nation? I mean, this is you're talking about entertainment, you're talking about concerts and things that have taken massive hits in 2020. When they start returning, does a stock like Live Nation outperform? That's going to be an interesting question. I mean, my gut feeling is yes. When the concerts begin coming back and this company starts making more money and we're in a low interest rate environment, I think their valuation is going to start to pick up. Again, are they going to be leaders? I don't know if they're going to be leaders or not. We'll have to wait and see. All right. So, in breaking it down, I would just simply say, and we could look at the mid-cap stocks as well, bring up the next list of stocks. Look at the scooters, by the way. Let's go back to the large cap. Look at the scooters in order: 67, 61, 25, and 4. And then mid-cap. Planet Fitness, 56. World Wrestling Entertainment, 12. Madison Square Garden, 7. Carnival, 3. You got one here, RCI Hospitality, 95. Volume yesterday was only 52,000. I'm not familiar with the stock. But SeaWorld Entertainment is probably the only stock in all of this area, all, small caps, mid caps, large caps. I'd say SeaWorld's probably the only one that is tradable in this group right now on the long side that has a scooter above 70. And it did break above the June and the September high, and its AD line is strong. Now, is this my favorite stock? No, I'm just saying on a relative basis to all the others, it's probably the best one out there that I've seen. Now, if I type in that other one that had small volume, Rick, you can see normally trades below 100,000 shares, but you can see at least on a price chart why the stock's doing better. And during this rally, we can see the AD line picking up as well. So it's not a bad stock. It's just illiquid for me. I wouldn't trade it because I just don't trade stocks that have light volume like that. And they're a lot better looking stocks. Even though this one looks good, it hasn't taken out the February high. Pretty much every stock I trade is already past the February high. All right, let's move on. I want to go into chart lists. So this is a new segment that we started a while back, but just give you a sense of some of the stocks within our chart lists that we create and provide to our members frequently. They can download these chart lists that we do all the research, we put them together, and then members can download them into their stock charts account if they're an extra or pro member. Otherwise, you can view the charts. You can view all of our charts and all of our chart lists. You just can't download it into your account. And the advantage of being able to download into your account is, first of all, I could view all. I mean, there are just tools that you can use at Stock Charts to view all these charts. I could do let me do candle glance. That defaults into 30 charts at once. So I've got a lot of charts on this list, but I could quickly scan through and look at all these charts at once. Look at this one, just breaking out Avalar. I know that was a fan of Grayson Rose's over at Stock Charts when he was on a few months ago. But look at Avalar with that triple top breakout. I can see that very quickly on our strong earnings chart list by bringing up candle glance. So it's pretty cool, to be able to use that. But one of the things I do I do it every day. I do it many times a day actually, is bring up the summary view of all of the chart lists, because I can quickly see what's moving. Yesterday, BlackBerry was the best performer on this list. Roku's been on fire lately. I don't know if you've been watching that one. And then you got something like On Track, OTRK, that I think I wrote about this one, but there's a nice little bullish engulfing candle off of this downtrend, right at the 50-day moving average. So anyway, you can take a look at BlackBerry. Now, do I like BlackBerry? No. I mean, yeah, I had a great day yesterday. It broke, it's on our strong earnings chart list, so it's worth keeping an eye on. I identified what I thought were two key support levels, which was here back in July, and then this one here. And the reason I go back to this one is because as you move up and put in a new high, short-term higher high, there's your higher low, there's your higher high. And everything's been trading between that. I think as long as BlackBerry stays above about 430, I'm okay with it. But is it my favorite stock? No, on a relative basis, it hasn't broken out. But it is still at least in an uptrend until it breaks below that $4.30 level. All right, let's see, what else do we want to talk about? Well, let's go back here for a second and look at the chart list. So if you want to see what's not working or what didn't work, you can go in here, hit that percentage, and it reverses the order. So now you got a specialty chemical company that didn't work out very well. Still in a nice uptrend though. I think this is a nice looking chart. Renewable energy group might have more to do with renewable energy based on the name of the company than it does specialty chemicals. Not sure. But anyway, nice push to the upside and a pullback. Watch that 20-day moving average. I mean, PPO has been strengthening. Usually the rising 20-day is a good entry point. So even weakness, I use as an opportunity maybe to find stocks that I might want to trade on the long side, short-term trades. And I think if I go back and look on that, there was one company, I don't remember if it was a earnings beats digest, our free newsletter. I don't remember if it was that or if it was something I mentioned in our daily market report to members. But I remember talking about this one when it hit $23 and hit this support area. Hit gap support, top of gap support, and the 50-day moving average. Bounced right off of 23, and now look where it is, right back to the high. That's a $6 move in 3 or 4 weeks. 25%. That's why we do all of our homework. That's why we establish these support lines, so that when you're going through and you're looking, you at least have a general sense of where you might consider a stock if it pulls back. I think, we do a lot of homework for our members. It's a really cool service, I think. We got some interesting testimonials yesterday and the day before after a couple webinars we did. And there was one in particular, and I'm going to go ahead and let me see if I can find it here for you. I really liked it. Don't worry, I won't give away any names. So I don't know if this was the same one or if it was 2 different ones, but it was 2 paragraphs here that was posted on our Slack page. Someone else here at Earnings Beach posted it, but it says, "Thanks so much. I've been trading for several years now, and your service is by far the best. I will continue to shout your praise to my friends and acquaintances. I'm simply blown away by the volume and quality of the information that you folks provide. I'm finally making some serious money after years of searching for the Holy Grail. I believe that I finally found it in the relative strength approach that Tom applies to the markets." Of all the things we do, and I get the most satisfaction out of getting testimonials like that, because it took me years to figure this out. And I don't have it all figured out, I can promise you. When you think you got it, you know it all, that's when you probably should just leave the market and go play golf or hike or play tennis or whatever it is that you like to do, travel, because the market's going to just overwhelm you if you think you know more than the market. So I'm always trying to learn, but I've picked up a lot of things over the years, and that's what we try to do through Earnings Beats is pass it along, just pay it forward. And so when I get those types of emails in, it really makes me feel good about what we're doing as a company. All right, let's keep moving here. I'm going to go into earnings reports and just give you some of the companies that reported this morning. And when we first start earnings season, you note that most companies are reporting before the bell. Most large companies report before the bell, the conglomerates. I don't know why, I guess maybe it's just tradition. But then others, when we get into technology, most of those companies report after the bell. It's kind of weird, but the first week, most earnings reports are coming in before the market opens. And all of them that I'm going to tell you about right now, all reported this morning. All of them are either up or down by 3% or minus 3% or less, in that range. Up 3%, down 3%. So we don't have any huge movers this morning. United Health, if we look at it on a relative basis, not bad. Relative to its peers, it's actually one of the leaders. They came in with an easy beat, $3.51 versus $2.98. Stock was up 1% in pre-market. Bank of America missed. This was the one company, I'm looking down the list of, yep, it's the only company that missed earnings. 51 cents versus 53 cents. And relative to banks, it's actually done pretty well. It's just that the bank group's been so weak. But this was one of the leaders in the banks, and they missed their earnings. I don't think that bodes well for banks. If one of your leaders can't even beat estimates, I'm a little concerned. ASML, this is in the semiconductor space. They're down 0.5%, but they blew the numbers away. 296 versus 258. You want to know why semis are doing well? Look at the AD line on this stock. Yeah, it's been going sideways for 3 months, but this AD line is going up. I think it's being accumulated. I think we're getting a breakout. Now, maybe it's not today. We are down 0.5%, but if we open lower, I wouldn't rule out the possibility of a push to the upside. I think the stock's going higher. WFC, Wells Fargo, they actually beat a pretty good surprise, 56 cents versus 47. Your reward, you're down 1.75% today. Look at Wells Fargo. What the heck? Look at the relative strength versus banks. It's one of the worst banks, and banks are one of the worst groups. Stay away. I bank with Wells Fargo. I mean, but I don't invest in them. I will not. You're not going to see me putting any money into Wells Fargo other than a deposit in their bank. Goldman Sachs, huge beat, 968 versus 558. That's $9.68 on the bottom line versus 558 expected. Stock up 2%. Look at the AD line's been weak. Relative strength been, mostly just flat for the last year, and the group's been in the tank. Stay away. All of these that I say stay away from, they'll have their day in the sun, and when they do, wait until they show relative strength, then get in. I think in the meantime, it's just money going down a rat hole. INFY, slight beat. This is the best reaction to earnings. INFY up 3%. Well, you can see now up 3.75%. We just opened. So you can see nice action here. Look at the relative strength on this stock heading into earnings. Off the charts the last 3 months. They beat, and then the stock goes up even further. Now, I would expect at some point this to be buy on rumor, sell on news. So we might even see a reversal on INFY later today or over the next couple of days. But I like the stock. When you're beating your estimates and you're in an uptrend and you're a relative strength leader, these are stocks I'm going to be interested in. I can guarantee you, if they beat revenues, I didn't see their revenues. If they beat their revenues, then I guarantee you the stock will be on the next strong earnings chart list when I update. USB did move up a little bit here, about 2% today, but again, AD line weak. Relative strength has been strengthening versus the banks, and they did come out with a pretty decent report, 99 cents versus 93 cents. But again, you're mired in the area of banking, which is just not good. PGR. This is Progressive. Nice AD line, nice price action. Stock up a little bit today. 187 versus 169 on the bottom line. Look at the relative strength here versus its peers. Peers have been awful, but PGR has been so strong relative to its peers that it's actually gaining ground on the S&P 500 while its peers lose ground to the S&P 500. That is the type of stock that I might even still consider for portfolios. I did this with both Chipotle and Wingstop in the restaurant group. Restaurants weren't good, but those two stocks were performing so well that they were in our model. One was CMG, I think, was in our model portfolio last quarter, and it's in one of our other portfolios this quarter. And Wingstop, same thing. If you've got stocks that are in bad groups and can still outperform the S&P 500, have good volume trends, the AD lines are strong, why not own them? They're leaders. You're making money with them. Now, these types of stocks, I'd probably be more tempted to keep stops on because the group is weak. So if all of a sudden the stock begins to show relative weakness versus its group and the group's bad, then it could fall apart pretty quickly. But as long as it continues its uptrend, I'm fine with it. Look at Progressive. When I talk about the AD line and how important it is, this is a poster child of what I'm talking about. Look at Progressive back in March. Remember all the gap downs we had back in March? I remember waking up and literally not even wanting to look at my phone because I knew what was going to happen. I was going to see Dow Jones futures down 1,500 points or whatever. We had so many gap downs back in March. Look at the candlesticks on PGR in March. If you're a candlestick fan, you know what you're seeing here is almost zero in the way of filled red candles. We had one big red candle during the entire month of March. Big red candles mean you close way below the open. That's a sign of distribution. we had one of those candles. Look at all these hollow candles. You're closing above the open. Look at this red hollow candle. This means you closed below the prior open, or excuse me, you closed below the prior close. So you actually lost ground from the prior close, but you're way above the open. So here, PGR would have been about $77.50. It opened the next day at $67, but closed at 73. So it was all the fear and the panic that drove the stock down, but then there's accumulation during the day. Price was going down in March. Look at the AD line going up. I wrote about this back in March, and I've been talking about it all year, about the AD line and how important it's been in our trading and for our members. We had a bull market and a bear market going on simultaneously. Half the market was gapping down and selling off. The other half of the market was gapping down and roaring back. And you had to see that difference to do well in the market this year. All right. Anyway, last earnings was PNC. I know we're running a little over. Mondays and Wednesdays, I usually run a little over because I don't have that time constraint over at Stock Charts. Anyway, PNC, you can see AD lines weak, price action been going sideways relative to the banks. It's been doing pretty well, setting a new 52-week high. It did beat by a wide margin, $3.39 versus $2.09. That's a massive beat. That's about a 65% beat over the estimate. That's a lot. And for all of that, the stock's up 1% today. You just got to avoid banks. I mean, I can't overemphasize right now. You've got to avoid banks. I mean, this is with the 10-year Treasury yield even getting a pretty good boost recently. Banks showed a little bit of relative strength. Last 2 days, we're seeing 10-year Treasury yield down, and banks are coming right back down again. I mean, they just can't sustain anything. Let them bottom, let them start to show strength, let them start to show relative strength, and then we'll start looking at banks. All right, I'm going to wrap up with the 3 you must see. I'm going to start with ALT, Alt Immune. This is a biotech. I think this one is an interesting chart. I think I need to show you this annotated so you can see what I'm looking at here. But it's been really weak the last few months, and you might look at it and say, wow, this was 35. Now it's 13. It can't be good. Well, I mean, one thing that you see in the market is when you break out, you go up, you go to this high, okay? We break out, we come back, we test that high. You break out, don't quite come back to that prior high, but you get pretty close. You break out, you come back to that high. You break out, we've just come back to this high. We haven't broken down yet on this stock. Yesterday, we saw volume pick up, and this stock went up to 16 and change, taking out this September high. It actually moved to about a 6-7 week high yesterday. Stock's back down again today, but we did close above the 20. And if we reverse today, this could be starting something to the upside. We'll see. AD line is weak. AD line, as much as I'm watching it, still remains a secondary indicator, just like RSI, just like PPO. It's still price support and resistance for me, still always going to be number one. And I think we're at a major area of price support on this chart. So I think this is a stock that certainly could reverse. It's a biotech. It's a small company. It's not for everyone. It's very aggressive. If you can't stand the thought that tomorrow the stock could be $12, I wouldn't touch it because it's a biotech. Yes, it could be $12. It could break down. It could break these lows. I'm just saying that buying it here versus buying it at $27.50, the risk is a lot different at this point after the selling we've seen the past few months. All right, last 2 I have for the 3 you must see. First, I'm going to show you Tandem. This is a medical equipment company. This is Tandem Diabetes. Stock's been moving higher. Look at the medical equipment group breaking out to a new high. Tandem relative to the group is at a 52-week high, relative to the S&P 52-week high. And I think medical equipment's okay. It's not been the best group, but it's okay. But we just broke out again with the group breaking out. We broke out, relative strength breaking out, AD line. It's a nice looking chart. And we did go sideways here for the past 6 weeks or so. Nice little cup, maybe a little bit of a handle. It looks to me like we're breaking out. I believe you're going to see, I'm going to say 130. It would be my initial target on this chart. And I would expect that fairly quickly. We'll see, but I believe we're in an uptrend. We're above that 20-day, and I think we'll go to 130 or above. Last one I wanted to mention was a big breakout from yesterday. Don't know if you saw it, but TDOC taking out these highs. So we had the big high in August, pulled back, set reaction highs, 2 of them, double top at about 230, pulled back, set this bottom. So now in this range, kept going up, couldn't get through. We're holding the 20-day. Yesterday, volume starts to pick up. We broke above the 230 level. I think this pullback down to the 20-day moving average is viable. I expect Teladoc's going to make a run for this 250 area to challenge that August high. All right, that's it for today. I know we ran a little bit over, but thanks for hanging in. We will be back, or I'll be back tomorrow over at Stock Charts for the next Trading Places Live. I'll be back here at Earnings Beats on Wednesday for the next Trading Places Live here at Earnings Beats. So love to have you join in. Remember, later today at 4:30, we've got this sneak preview, Q3 earnings. If you want to come in, find out a little bit more about how we look at the market, I would highly recommend this. Open to the public. The only thing I ask is if you come directly in, what we do, anybody comes into our community, we add them to our free newsletter. Again, no credit card required. You can unsubscribe at any time. That's the only thing we ask. So if you come in directly through the link, we'll add you to the Earnings Beats Digest. And again, so unsubscribe at any time. But I think you'll like what you hear tonight if you come in. So we'd love to have you. Anyhow, everybody have a great day. Happy trading.